The window in the juniors on the bullish side is a lot shorter than the bearish cases for it. So we can't get too caught up with it. And when we start to hear it from non-mining people, it's time to buy juniors. Instead of encouraging them, we need to start looking for an exit, but we're not anywhere near that yet.
That means on the 1st of July, 2025, technically gold has to be deliverable on a T+1 basis on the COMEX. Well, in the USA. Now, well, that simply means that you're going to have to stump up full margin for the product, if otherwise it's not a first-tier asset.
Despite concerns that gold was overstretched at $3,000 per ounce, the metal defied expectations, surging further this week and peaking just 13 shy of $3,100. This rally was fueled by mounting inflation fears, escalating geopolitical tensions, and renewed tariff pressures, all reinforcing gold's role as a premier safe haven asset. In 2024, while the S&P 500 posted an impressive 25% total return, gold outperformed, closing the year up 27%. Historically, gold has demonstrated resilience during market downturns, outperforming the S&P 500 in 8 out of the 9 years when equities delivered negative returns. On average, gold returned 19.4% during these periods, compared to the S&P 500's negative 5.3%, reinforcing its value as a hedge against economic instability. Despite equities rallying in a volatile 2024, gold's strength was driven by persistent inflation concerns, central bank demand, and geopolitical uncertainty. The S&P 500 to gold ratio has now dropped to its lowest level since the pandemic, signaling a shift in investor sentiment towards safe haven assets and serving as a cautionary indicator for both the U.S. and global economies. Peter Grandich argues that despite gold outperforming stocks and bonds, financial advisors rarely promote it. Even a tiny allocation shift could drive a significant price surge with institutions underexposed. He sees no major concerns for gold's future, acknowledging a possible 10 to 15% correction, but maintaining confidence in the overall uptrend. Maybe that correction starts at $3,500. While he once viewed $2,500 to $3,000 as reasonable targets, he now acknowledges forecasts as high as $5,000 or even $10,000. We're about to explore the video, but first subscribe and hit the bell icon to keep up with our newest uploads. Your feedback in the comments is always appreciated.
So that mentality has always also been in the gold market. Gold's just, trades here and internet bullion house that would tell us, are you crazy? It's never going to stay up there and all. And there's no such thing as manipulation and all. And even when it got to 2000, even some of the people that were in the market, maybe not publicly, but privately said, do you really think it can get much through 2000? What will drive it through 2000? They're saying the same thing now about 3000. They really are. It's the best kept secret, except for people like you and I that and some others who've seen it. And here's the last cherry on top of all of that. So you have these financial advisors, and again, Andy, I'm speaking just for the U.S. I don't watch Europe financial networks, but here in the U.S., they have talking heads on every day, and it's either stocks or bonds. It's all stocks, bonds. And I say to people, let me ask you something. If you went to a doctor and he gave you a drug, but you found out later there was a better drug you could have taken to make you better, would you be upset? They go, yeah. Well, those people that were telling you to buy stocks and bonds since January 1st, 2000, never spoke to you about gold, yet gold has outperformed both of them. Maybe you should look for a different doctor or a different financial advisor. And that's the real cherry on the top, Andy, of how well it's performed, despite being very, very underowned here in North America by retail and institutional investors.
Yeah, and it's not just this quarter that gold's outperformed. I think, Peter, almost every other asset class. And it's like, so these guys have to be waking up. And when they see, that they work as a herd, as we know, they always work at a herd. And gold was like, if you were in gold, you probably, the only chance of getting fired was the fact that you weren't doing what your friends were doing. Even if you all lost money together, you'd probably keep your job. But if you went into gold and even if it made money, you'd probably risking getting fired. But and I do speak to people out there, and you do, are starting to wake up that, hey, okay, 3,000. Again, they don't know if it's 3,000, 5,000, 10,000. to them, it's not even, it doesn't even register what the supply demand fundamentals or anything.
And then this tow truck called the Fed came along, the Fed threw a bunch of money at it, fixed the road, and hey, step on the gas, go forward. And that coincides with what we said before about the herd mentality and all. And so that's the big issue out here, I believe, in the US, the true lack of experience. It's an amazing thing. They have no concept of a bear market. And I think we flipped 180 degrees from what I told you in the early 80s. They made gold as important as stocks on a world basis by the central bank's banker. I mean, you're more qualified to comment on that, but a lot of people like to say the BIS is the central bank's banker. These banks aren't buying this for a trade. All this enormous known physical buying, which we think there's been more than the actual reporting, especially out of China. They're not buying it for a trade. They can't trade it to somebody else and lock in the profit. They're buying it for a significant reason, okay? Two, we saw the BRICS. We understand they're going to come up with some sort of formula to settle their trade using gold in some fashion, along with currencies or something else. We don't know what the final thing will be back. Why did all this gold start to get transferred? And why would the president of the United States, unsolicited, start talking about whether or not there's gold in the Fort Knox? I don't understand any logic in that if there's any question that it's not there, which some of us believe may not be, or to the point of the level that has been reported and all. And so all of this and this transferring of the gold and the president talking about, the secretary treasury talking about it and all, gold's going to be used some way more than it's been in the United States. There's no question about that's coming as well. So it's all green lights. I can't, if I wanted to try to come up with a reason other than this, we've had a big move. We went from 2,000 to 3,000. We could have a 10 or 15% serious correction at any time, but maybe that starts at 3,500. It doesn't start at 3,000. But I can't come up with anything for a long-term change of opinion on still why gold needs to be a significant part of one's portfolio. I just can't. It's hurt business, just so you know. Most people that I meet from the financial planning, they don't see that concept. They don't have the time or the knowledge to have the deep thinking that you and I do. So when they go down to the street to talk to the apples and orange, I'm Apple, they go see what orange says. Orange blows up gold. That guy's a nut, whatever they come up with. But by and large, there's nothing yet to even be mildly concerned that we've even reached an intermediate top. Yeah, there's short-term tops. There's going to be sharp corrections in bull markets like this. But this market still looks like it can still go substantially higher. And Andy, I used to say maybe we get to 2,500, 3,000. And there were guys that talked about 5 and 10. And I would say, maybe they're a little crazy. They're not that crazy anymore.
When the Bank of International Settlements, which is European facing, global south facing, diverged from the only central bank, there was only one central bank yet still trying to protect the dollar value of gold, which was the Fed, of the US Treasury, the Fed. So, and so really you had this split of central banks. And so now we've now got, and they were given, and this is the interesting thing, and not people are talking about this at all. They were given 2.5 years to comply with Basel III. That means on the 1st of July, 2025, technically gold has to be deliverable on a T+1 basis on the COMEX. Well, in the USA. Now, that simply means that you're going to have to stump up full margin for the product, if otherwise it's not a first-year asset.
Wall Street continues to raise its bullish outlook on gold as the metal surges to new record highs. Bank of America recently lifted its gold price target from $3,000 to $3,500 per ounce over the next 18 months, citing a projected 10% increase in investment demand driven by Chinese buying, central bank accumulation, and growing interest in physically backed ETFs. Gold's impressive 17% rally year-to-date has also caught the attention of J.P. Morgan analysts, who are now openly considering whether a $4,000 price level could be within reach. Institutional confidence in gold's long-term upside strengthens as global economic uncertainty persists. Do you trust their forecasts or believe they're late to the party? Join the conversation. Share your thoughts in the comments, give us a thumbs up if you found value in this video, and subscribe to stay engaged with our community.